Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffmann. I'm the JR mining guy over on X, and of course, you're a host of this channel. And as you can tell, I'm on the road. I'm on vacation actually, but it's still really important to get information on what is happening in the markets. And I've invited a fantastic guest, Tavi Costa. He's a partner over at Crescat Capital, and we're going to discuss the US dollar, the tariff situation, which leads to the recent deal the Department of Defense announced with MP Materials, which also leads to the copper price surge over $5.30 per pound, and probably much higher as once we publish this interview. And of course, we need to talk the gold and silver bull market that we're currently in. So lots of topics for a very short time period to discuss, but we'll make do here. Before I switch over to my guest, hit that like and subscribe button. It helps us out tremendously, and it's a free way to support it. Thank you so much for doing that. Now, Tavi, it is great to welcome you back on the program. Thanks so much for joining us.
Thanks for having me, Kai. Looking forward to this conversation.
Yeah, me as well, because you have a very strong background in mining, and I hope we find some time at the end of the conversation to also talk about the mining complex and the opportunities you see. But we got to set the scene a little bit, Tavi. First, I mentioned I want to talk US dollar and tariffs, which are sort of interlinked directly. What is your current assessment of the US dollar and then the tariff situation?
Oh, I think we're in the process of more people recognizing the situation that we had not too long ago. I think since the Fed started to really raise rates, we enter a scenario where interest payments to GDP have surged to levels that, if we look historically, this is completely unsustainable. And I mean this from research going back to the 1700s. And usually when you get to this range of between 4 to 7% of GDP is when things start becoming quite critical. Or you can also look at when your interest payment really surpasses how much you spend on defense. And we've been in that position for some time now. So eventually, what happens is that if you just look at interest payment to GDP relative to the rest of the world and other developed economies, there's not a single economy that is large enough, like the US or other G7, G10 economies, or even G20 economies, that is running anywhere close to that amount. So we're going to see a greater sense of urgency from the US to have to reduce rates, either through a Fed chair that is appointed by Donald Trump, or by just yield curve control, or by revaluing gold in the treasury and buying back treasuries. There's so many mechanisms that could be used, but one of those is going to have to be used, and most likely we as investors need to sort of operate under the assumption that we're probably going to see lower rates and a lower dollar as a result of all this. So this is, I can't imagine a world where all this happens and we're not going to see some very profound changes in terms of allocation from US-based assets into other parts of the world as well.
Yeah, before we get to tariffs, Tavi, maybe like you mentioned historical context. Like, have you ever seen a time in the history where a country has been able to sort of roll back its debt or figure out a way to sort of make it sustainable, the situation?
Yeah, the British Empire would be a great example of that. What they did back in those days, they created a sinking fund. And so they basically were trying to reduce the issue from a market standpoint. And then what they did is they try to term out their debt. And they, at some point, try to basically purchase their own treasuries at that time as well, which is very similar playbook that we saw in the 1940s, although that was the beginning of the dollar dominance. But that was a critical change at that time. It ultimately cost their currency. It's just a devaluation of the currency relative to other currencies in the world. And so I think the issue with the U.S., on the other hand, is a bit different on a few things. I mean, I think a lot of people talk about the fiscal issue, the fiscal deficit that the U.S. is running at about, call it 6 to 7% of GDP, depending on the month. But the other aspect of this that I think it's absolutely critical is the trade balance, or you can call it the current account issue. The current account problem is also at a level that we have only seen, somewhere really in the early 1900s or late or mid 1800s as well. And so how do we fix that problem? Not with the strong dollar. And so it's highly unlikely that a strong dollar would be taking place in the near future, just because of those constraints. So we're running at about 10% twin deficit. So that's the fiscal plus the current account. That's just unsustainable. You can't run an economy for too long in that direction. It's almost like, if you think about a company, it's the same thing with the government, right? The government receives two forms of revenues. It either comes from taxes or more exports relative to imports. On the tax front, we're doing a deficit, right? We have a 6 to 7% deficit on the fiscal front. On the current account side, which is your trade balance, we're also running a 3 to 4% number in that front as well. So, that's just, you're basically compounding your debt on a double-digit base every year. So it is a very scary situation that ultimately drives two things. Like just to as an exercise, Kai, just do one thing. If you take interest rates today to zero and basically say we're not going to pay any interest payment anymore, which is a very radical shift in policy. Obviously, that would cause a lot of crazy behavioral changes in markets. But let's just assume we see something along those. We're still running a minus 4% to GDP deficit today, which is insane. And so the way I see it is that ultimately we're going to have to reduce a few things. The trade balance is going to have to be not going to a surplus, because we're still, if we want to keep the reserve currency status, we still got to run a deficit. We just can't run a very steep deficit. On the fiscal front, we're probably going to have to, step one, lower rates, suppress rates somehow. I gave 3 options there earlier in the conversation. And then the second aspect of this is going to be your primary budget as well. Your primary deficit has to be reduced. What is a primary deficit? This is a very normal topic that I'm from Brazil. Emerging markets talk about these things all the time. Why? Because we have issues with our currencies pretty much every year. And so the main reason for it is, how do you calculate a primary deficit is just your deficit minus your interest payment relative to GDP. And so that's your deficit, your primary deficit. That inside of that section, you have pro-growth spending and non-growth spending. Those are 2 separations. Right now, entitlement is basically eating up your pro-growth spending. So at some point, what we're seeing is a collapse of pro-growth spending, of which remains at a very high level compared to the rest of the world. No other economy is running a primary deficit or a pro-growth deficit like we're running in the US. Once we start switching that, what we're probably going to see is that American exceptionalism is going to be more and more challenged, and ultimately is probably going to be driving capital flows out of the US and into other places. And so I do think that's a real trend, and the dollar shift is going to be one of those asset classes that are going to be impacted by this.
I was going to say, just to summarize what you've been saying, all I'm hearing is that the U.S. will have to give up world reserve currency status at the end, that the U.S. dollar will become way less important. Is that a factual summary? It seems like if you default on your debt, everybody flees out of the U.S. dollar. The reserve status is done. Right?
I think that
if you were to summarize it like that.
Well, I think that's a potential consequence to the problem, but I don't think it's we could see the U.S. Having a weaker dollar without losing its reserve status. We're certainly flirting with what you said. If these changes were not addressed, I think we would be already having some problems. I mean, the British Empire was able to keep their things going for another for a long time. I was that period that I was referring to, the sinking fund and all those things, probably happened in the mid 1800s, and so these things can last a while. It doesn't mean that you're running that you're going to hit a wall of debt, that you're necessarily going to be having issues losing your reserve status. I think that the bigger picture for an investor is just think about it's. There are a few investments out there that hate a strong dollar. Hate emerging markets is a great one. There's 2 factors that really change capital allocation. It's a strong dollar, but also the interest rate, a very high interest rate environment. And the US simply cannot afford both. So if you're an investor, that's where you need to operate. If they're going to lose the reserve currency status or not, it's really a question of how the magnitude of those changes would be in terms of how extreme. But I think you certainly want to be investing or allocating money under those assumptions. And so that's a green light for a lot of things. It's a green light for other developed economies, but major, especially in emerging markets. It's a green light for Latin America, in my view. It's a green light for natural resources. For some, it could be a green light for crypto, and it certainly has been. And so I think all these things, could be ways of protecting against what's likely to happen. Not just protecting, but really growing capital. I think it's going to be a very I'm excited about these changes, because I think we're going to be seeing a lot of things that have been neglected for a long time come back into the radar.
Now you make some really interesting points there, and a lot of food for thought here, Tavi. And one thing that jumped into, or that popped up, that I want to ask you about is a lot of the U.S. debt is of course domestically owned. About 75%, if I'm not mistaken, on about 25% is sovereign held. What if the U.S. were only to default on the domestic debt? Keep the southern debt. We'll pay our southern debtors just to keep the status quo, but default or stop paying interest, as you called it earlier, just on the domestic debt, without maybe not even defaulting, but maybe pushing it back or saying, hey, we'll pay you back at a later time, or just scrapping it all together, just defaulting on that part. What would that is that even a possibility? Just to keep the what do you call it, the act? The game alive with southern debt holders, China, for example?
Look, I think everything is a possibility when you're talking about macro or geopolitics, but it's the question you asked about trying to summarize some of those ideas and saying that maybe we're going to see the loss of the reserve status. I think if we see a radical shift that you propose or suggested here as a probability or possibility, it would certainly, I think, add to the case of the U.S. losing reserve status. I think it's unlikely. I think that would be a very crazy situation. I think it's more likely to see, why not just take rates to 0 or 1% and let inflation run hotter than historical standards, which has been already. To me, it's crazy that we're still, talking about CPI. Just look at the commodities equal weighted index. It's completely divergent from any other data. And I'll post a chart on this next day or two. I just find that fascinating, because that's your real compounding effect of cost of materials and so forth that is running into the economy. That's your real world. It's all CPI. And so I'm a little, I think that those, if we're end up seeing what you just said, which is, look, I think it's more, here's what I think is very, probable in this environment of the 1/3 of the debt, is seeing some level of a Mar-a-Lago Accord, some level of agreement of which countries would accept U.S. debt for much lower rates in the long term. So let's say 30-year treasuries at 2.5% in exchange for something. And I don't know what it is. And it could be military related. It could be a lot of things. I think the U.S. does have a lot of things that other economies want to have, and so the other way around. So I'm just saying that there is a real possibility of that occurring in the next few years. I do think that could be a real thing. But again, that only answers 1/3 of the debt problem, like you mentioned. That's the foreign investors. We still need to. What we are probably going to see is banks. They're facilitating the banks to buy more treasuries. That's probably going to be a big answer for the demand for treasuries. We're probably going to see mechanics in terms of these changes in terms of treasury buybacks. How do you do that? You got to increase the cash balance on the treasury by revaluing assets, potentially gold, at a much higher price. Those things are kind of unthinkable today, but it could certainly be on the cards here.
No, it's interesting. A lot of theories floating around. You mentioned the Mar-a-Lago Accord, which is based on Steve Mirren's playbook, of course. So lots of ideas, but as you said, like we all really, like, we're still all guessing what might be next, right? And what the real playbook is here, Tavi. One part of the playbook perhaps are tariffs. We really have to talk about those real quick as well. Like, they're supposed to help close the deficit gap. I think it was the Congressional Budget Office that estimated $255 billion worth of revenue to come into the U.S. based on tariffs for this year. Not that was a few weeks ago, so things are changing, of course, on a daily basis. Tavi, what is your assessment of the tariff situation right now, real quick? Because I do want to talk about the commodity complex here in a second. But what is your assessment on the tariff side, and is that a feasible way to sort of restructure the situation?
Yeah, I mean, it's taking care of that one side of the deficit, twin deficit problem, which is the trade balance. And I think the biggest aspect of the trade-related policies, tariffs being one of them, but I think there's going to be a lot more, is the dollar too. And usually people tend to say that the dollar tends to strengthen under tariff changes in terms of the U.S. economy. And that certainly is not supported by history necessarily, especially at times when, like, a great example was maybe in the 1970s when Nixon was trying to impose tariffs. And ultimately, he was also challenged by the court. I think it was 1971 or 70. And he was challenged by the court as well, and couldn't really impose it. So then he used the justification of the time was a problem with the balance of payments. Ultimately, this is a kind of a long story to come down to the real answer to his problem end up being just letting the U.S. dollar devalue, not just against hard assets that we all talk about, but against the Japanese yen. Which was the currency at the time that the U.S. was running its largest trade deficit. And so you have to sort of consider these ideas today, like which ones are the economies today that we have the largest, the U.S. is running the largest deficits with. If you run the math of that, it's Canada, it's Mexico, and then it's China. China is not the first, actually. And what is interesting about this is that not a lot of people think, especially market positioning, is very not considering the idea that if I ran a calculation, for instance, what would it do if we want to fix the U.S.-Canada deficit issue? What would it do to the currency itself, the FX of the Canadian dollar and the U.S. dollar? If we just wanted to change that alone, well, you got to run a few other considerations like the elasticity of those agreements and so forth. You run those assumptions, you could see 30 to 50% appreciation of the Canadian dollar. Of course, that wouldn't happen tomorrow. It would happen over a course of versus the dollar. That's one way you could fix it. And maybe you may say, well, that's one factor. It probably won't happen that way. What if it happened one fifth of that, like 10 to 15% change in the Canadian dollar? What if we see that? And then throw that on a chart, just as a model that on a chart and see what it's a clear breakout from a major downward trend. Things can change very quickly in the macro environment. And I think I like those things. I like when there's asymmetry on an idea. Now, I was in a conference not too long ago. No, it was November of 2024. It's been a longer than I thought. But and I remember asking the audience, it was like 300 people there. Raise your hand who thinks here the Canadian dollar is going to outperform the US dollar in the next 6 months. You know how many people raised their hand? A guy right by me, Roni Sterfele, because he agrees. And I just thought that was really funny. I was like, wow, I need to increase my exposure to that right now. So,
well, I think Canada has a branding issue right now as well. So,
no, I mean, there's no shortage of issues, and it's like investing, as you know well, in mining companies. There's no shortage of problems. It's a rate of change of improvement or not, and that is the meaningful thing that we as investors need to be focused on. And by no means I think the Canadian dollar is a better investment than gold or silver or copper or others. But as I don't think the U.S. is the cleanest of all dirty shirts anymore. I really don't think that's the case. If we reduce rates to, a lot lower and the dollar gets adjusted by that, I'm happy to change my view on this. But with a 4 to 5% interest payment to GDP, of which any other economy in the world is running at below 2%, I don't think we can sustain this. It's going to be ugly.
Yeah, no, absolutely. I was just writing down a question. I need to ask you about investing into New York Stock Exchange listed companies that are US dollar denominated, obviously, later on, if we have time for that question, Tavi. But, the reason I ask you about the tariff situation is that it has massive impacts on the mining space, the sector these days. And just last night, my time, I saw that the Department of Defense struck a deal with MP Materials, for example, on the heavy rare earth side, investing $400 million in straight equity into the company, providing grants and other access to capital. What are some of the ramifications now of the tariff side? Because the U.S. not apparently, but obviously was asleep at the wheel when it came to resource securing the supply chain. What is the effect on the mining industry in general? Like using that MP Materials deal maybe as a blueprint. Do you see more of those deals happening in the future?
Look, I think this is a critical development that certainly deserves more attention. I think that the Department of Defense making a strategic investment on a public company of north of 15% ownership stake. I cannot recall a time in history we've done this. In fact, I looked it up. When was the last time we've done this? Outside of bailouts, those don't count. I'm talking about a strategic investment. The last time we saw this was in World War II in the 1940s. And that was a time when the government decided to put their own capital, I think it was called the Defense Plant Corporation. And what they did at that time was owning a bunch of factories to ensure that the U.S. economy would be able to still produce and generate all the materials, vehicles, aircrafts that we needed. And you can say, this is almost like, geopolitically speaking, this is as critical as that time in terms of our needs, in terms of materials, and we're nowhere close. I mean, this is a foundational risk for the country. The fact that the U.S. does not have the raw materials necessary for its industrial revival, and more importantly, its innovation curve that we're seeing with AI and all sorts of things, that it's a real innovation race with the rest of the world. I think this is one of the biggest things that I can recall in the last 6 months or so, or maybe a year, that I've seen. I think this is absolutely critical. I think we're going to see more of that. The tariffs on, call it in copper, I think that's just tactics. I don't see the U.S. staying with 50% tariffs on copper. That seems to be like not only shooting themselves on the foot, but in the entire body. That just seems like a complete, stupid idea. And I don't think they're stupid. I think they're just doing this for negotiation tactics. But this investment, strategic investment on a company, this is a big change. Now we can say, oh, Fireweed got some small relative to this. It wasn't even great for them and for all these other companies, Canadian companies that got a few of those grants and investments. But this is an actual equity investment in a company, and I just find that fascinating. I don't, I had to look it up. Like, who owns this? Like, is that in a treasury balance sheet? Whose balance sheet is this? And they report a balance sheet every year through the Department of Defense. You can see that. And I was like, how much cash they have? What are they going to do with this? I mean, is that going to be more? My brain started moving very quickly in that direction, because I think we're going to see a lot more. I think this is just the opening for a lot more transactions. This is absolutely critical.
Yeah, you touched on the copper. Do you see any of those type of transactions happening in the copper space? Well, Arizona is full of copper projects that need financing, permitting, financing, and things like that as well. What is the likelihood there?
Look, I remember talking to a few CEOs back in the days, companies that were in Alaska and other places, and I remember saying to them, I think we're going to see major subsidies of the government to help some of these projects that are completely not economically viable from a normal capital lenses to become viable. And China has done that in many projects. And why can't we see this in the U.S.? And so I do think it's happening. I mean, Northern Dynasty has been moving in a crazy fashion recently. This is probably one of the most interesting cases in the mining industry, alongside some others. But I find that fascinating. I think we're that's peanuts for the government to spend that level of capital. Sometimes we talk ourselves, we say this company cannot develop this project. It's going to cost them $15 billion. What's $15 billion for the government? It's nothing. They spend that on, every day on Ukraine in the last year. So, it's fine. I mean, they can come up with that amount. And that's not bashing on Ukraine or anything like that. I'm just saying this is a small potatoes close to what they usually spend in other projects in the government. So I do think we're going to see more of those involvements. Yeah. And it's what I'm a little shocked is that usually the stuff related to owning a company, like, okay, so they have a 15% stake on MP Materials. Like, I'm so curious about, do they appoint a board of directors? Like, are they just a passive investor? That sounds to me like what we see in countries like Brazil or Chile or Peru, state-owned companies. Hello, we've seen many of them in those countries. We're seeing that now in the US. It's really interesting, Kai. I do think this is a very important change in our industry. And it maybe, I'm not saying it's for the better or for the worse. All I'm saying is we're going to see more engagement of the government, and some of the projects that we both thought they're not economically viable. What if they are? What if the government is willing to put their own capital and screw us coming up with NPV calculations? That's what China's
giving us floor prices and everything, right?
I mean, I
for
find
optics, which is unheard of as well, which are almost 100% over market currently.
I think it's definitely a change. Like, we run St. Cristobal, not run. I mean, Quentin, one of our partners, is the CEO of St. Cristobal, and we can see her, firsthand in regards to the silver and the concentrates that we sell, in regards to how much of that is China trying to go, above and beyond trying to buy our stuff and paying a premium on things. And I don't think this is unique to St. Cristobal. I think this is happening with other companies too. And it's just you hear about these things until it happens with either businesses you're involved or investments you're involved. And it's something strange going on in the world, I gotta say. And it's kind of like war type of ideas. Like I just said, like, look it up. When was the last, if you find it, I'm happy to be wrong. When was the last time we saw a 15% equity stake on a company of this degree? I can't recall.
In the commodity space, right?
Exactly.
No, it's like, as you said, but we are at war, and I think the US is just catching up, and that's my own personal opinion, to what others have been doing. Like Zijin Mining, for example, everybody knows about the gold mining company out of China, which is pretty much state-backed. They're doing deals left, right, and center. I'm not discussing feasibility of it, but they're buying up a lot of gold globally, right? Being the long arm of the government. So I think the US is just trying to catch up here.
First you panic, and then you come up with solutions. And I think we panicked maybe 6 months ago on elections and all that, talking about all these things. And now people, but not to go on another tangent, but it's so important, these things, because we just haven't seen anything yet in terms of electricity consumption. I did a whole study on this myself. I'm not saying I'm right on things or wrong. I'm just a curious guy trying to figure out, where are constraints in markets. And one thing I learned in the last 3 months that I also thought was very relevant to me, that adds to this whole thing, is electricity demand. I read most of the reports from McKinsey and other consultants, and I was in disagreement with a lot of their assumptions and probabilities in terms of where they think electricity consumption would be in 3 years, 5 years from now. Just because I think they're clueless about the mining industry itself. Like, it's like Elon Musk saying we have enough copper in the world. Yes, underground, not above ground. Like how much does it cost us to get it off the ground? It's it's going to be a lot of and time. I just think that there's a bit of a misunderstanding of timing on things. It's like the nuclear space, talking about, yeah, this is easy. You just invest in nuclear. Yeah, nuclear is probably going to be here in 10 or 15 years. It's not your answer now. Like, what is the answer now? Natural gas, maybe, coal. There's just so many. I find this whole discussion fascinating because I do think we're going to hit a wall and maybe even see some sort of electricity shortage. And I don't need to be necessarily on the tape for this, but I just really think that could be a black swan event in the next 3 years.
Yeah. Absolutely. No, I agree with you, Tavi. One last minute here on gold and silver. We need to talk about the secular bull market you're still seeing in our space. Gold has been sort of moving sideways here the last few weeks, looking for a proper impulse. There's a bit of a what do you call it, a trade-off between safe haven investing and maybe US dollar weakness that's been sort of balancing the gold price right now. What is your take on gold right now, Tavi, and silver for that matter?
Well, I think we're seeing a few different things. Copper is in a price discovery phase. Gold is had a little correction, healthy, maybe 7 to 10%, which is, if you're an investor in this industry, I welcome those things. I think that's great. I'm a buyer of gold here. I think gold is at an important technical support. These technical supports don't really mean a lot, but I just like buying something that has corrected, that I believe fundamentally for the long term. And when you buy a little bit when it falls 10% or 7%. I that's my the way I invest, at least. Now, silver is behaving in a very interesting way, because despite this correction in gold that we've had, silver has been not just more resilient, but also strengthening. And I think not only we've seen this consolidation at 35 or so, now 37, I do think we're about to see a big move. And we've recently added more exposure to silver miners. I do think even the big names are likely to see some very significant moves. From a macro standpoint, they're going to be the first ones that people are going to consider. And so I do think silver is on the brink of a big move. And so I'm really focused on that as well. And I would say another metal that is off the radar that looks like, maybe I'll post this chart as well in the next few days, but it's really remarkable, the correlation that we've seen throughout history with copper and zinc prices, which makes sense in my view, at least. I think it's logical, but zinc has been really lagging copper prices. Just not usual movement. I really think it's not a problem. It's just a lag, and so it's an opportunity. And I'm really focused on zinc prices as well.
No, fantastic. Tavi, really, really insightful conversation. We have to wrap it up now, but we'll have to chat after the summer. We'll probably see each other in Beaver Creek as well, mid-September. I'm really looking forward to catching up with you in person there, and really appreciate your time, Tavi. Where can we send our audience to follow more of your work?
They can find my work at Tavi Costa on X, and also on LinkedIn, Tavi Costa, or on Crescat.net is our website where you can find our letters and things about our products as well. But thanks for having me, Kai, and look forward to speaking with you in person as well.
Absolutely. Yeah. Same here as well, Tavi. Thanks so much for your time. Much appreciated. And everybody else, thanks so much for tuning in. Really timely discussion about what's been going on in the US, primarily here, as we talk US dollar tariff situation, but also the impact on the mining space. Really, really important to see that MP Materials deal that the Department of Defense entered just yesterday. So we have to make sense of it. We'll have to figure out, where is this going? Are we going to see more of these type of deals? And are we going to see them in other commodities as well, like copper, like we've just discussed? So thank you so much for tuning in. Leave a comment and a like down below. And if you haven't done so, there's a free way to support us. Hit that subscribe button. Thank you so much for tuning in. We'll be back with lots more here from the road. Take care out there.